Looking at the number of auto loans in serious delinquency, the researchers noted that there was a sharp worsening in the performance of the loans held by borrowers under 30 years old between 2014 and 2016. The researchers said that overall, the end of 2018 saw more than 1 million more troubled borrowers than there had been at the end of 2010, when the overall delinquency rates were at their worst on record. Auto loans have also surged by almost 35% since the Great Recession, according to additional data. The substantial and growing number of distressed borrowers suggests that not all Americans have benefited from the strong labor market and warrants continued monitoring and analysis of this sector, the report concluded. A NewsPulse Finance analysis of the New York Fed data revealed that many of the higher delinquency rates are concentrated in the Southeast, with states like Alabama, Georgia, and Mississippi looking at the highest levels. Millennials with poor credit may be a key contributor to the trend. The strongest correlation is credit rating, as Chief Financial Analyst Greg McBride told NewsPulse Finance. Those with poor credit ratings have much higher delinquencies. It's much more a function of credit rating than age. McBride explained that younger people don't have a long and established credit history, which results in them being classified as non-prime borrowers in addition to depriving them of access to financing options from credit unions or banks. Borrowers with credit scores less than 620 saw their transitions into delinquency exceed 8% in the fourth quarter, the New York Fed report stated, a development that is surprising during a strong economy and labor market. McBride downplayed the idea that millennials' student loan debt burden created the need to delay payments to reallocate funds. If you run into financial difficulty, you have more flexibility on that than any other form of payment, with car payments in particular. You have absolutely no wiggle room. He pointed out that while auto loan delinquencies alone didn't warrant alarm, the situation was still worrying when looking at overall household debt, which includes mortgages, credit cards and auto loans. Auto debt makes up about 9.4% of the total household debt, according to the New York Federal. Auto delinquencies have never been the smoking gun that flashes warning signs that the economy is stretched to its limits and in danger of crashing, MUFG's chief economist Chris Rupke told NewsPulse Finance. It is a false comparison to say subprime auto loans are similar to subprime, no-doc home loans made over a decade ago that brought about the deepest downturn in the economy since the Great Depression. He added that unlike homes, cars can be resold with less of a haircut and less of a financial loss. Schatz added that the current situation does not resemble the 2008 crisis because, today, the consumer has a much better balance sheet and is not committing mistakes as egregiously as they did from 2003 to 2007. Arthi is a writer for NewsPulse Finance. Follow her on Twitter at @arthiswami. Follow NewsPulse Finance on Twitter, Facebook, Instagram, Flipboard, LinkedIn, and Reddit.